Welcome to the CLS Market Review for the month of May 2014. I'm your host, Sierra Morris. It was another strong month for the stock and bond markets, with the S&P 500 having its biggest gain since February and hitting new all-time highs seemingly on a daily basis. The bond market, meanwhile, had its best month since January, as 10-year U.S. Treasuries finished the month with a yield below 2.5%. International stock markets also performed well, highlighted by emerging markets up 3%. Could this be the turnaround for emerging market stocks? Even beleaguered markets such as Russia and Turkey had big months in May. Russia was up 14% and Turkey was up nearly 8%. Given the news out of Ukraine, many investors might be surprised by the strength of the Russian market of late. Does this rank as one of the biggest surprises of 2014 so far? Let's now turn to our Chief Investment Officer, Rusty Vanneman, to see what he considers are the biggest surprises of 2014. Rusty?
Thanks, Sierra. It's great to have you as the new leadoff hitter for the monthly market review. Sierra's right. May was another solid month for the markets, as the year has been. And it's been a solid year for balanced portfolios. That said, there have been some surprising moves in the markets. So what do I think are the three biggest surprises, and how do they impact our thinking and what we're doing with portfolios? First, the biggest surprise to most investors is the large drop in interest rates this year. Though investor sentiment was strongly bearish at the beginning of the year, rates have dropped for the bellwether 10-year Treasury by over 0.5%. Yields for the 10-year Treasury were over 3% late last year. A few weeks ago, they were at 2.4%. Why have yields fallen? And where to from here? There are at least a handful of contributing reasons we discuss in this week's commentary PDF and podcast, which I invite you to explore. As for what we're thinking and doing about the low rates at CLS, there are three key points to make. First, we recognize return prospects are not exciting given the low rates, but we also still appreciate the powerful diversification benefits to owning bonds. Thus, we are maintaining bond exposure, though we are keeping fairly defensive positioning by holding interest rate sensitivity fairly low. Second, we are starting to improve the credit quality of our bond positions by gradually reducing exposure to corporate bonds, both investment grade and high yield. Third, we believe in active diversification, which means not only actively managing our fixed income exposure, as mentioned earlier, but also looking to diversify by using alternative investments. If you knew that bond yields were to drop over 0.5% and knew nothing else, one would typically expect that inflation expectations would have dropped. That, however, has not been the case this year. Inflation-sensitive assets, such as commodities and tips, otherwise known as Treasury inflation-protected securities, are both on fire this year, providing above-average returns. Again, this is interesting as bond yields have fallen and official inflation data hasn't exactly spiked higher. In our view, the markets may be onto something here. Falling real interest rates, in other words, inflation-adjusted interest rates, are often inflationary. If we do indeed get an inflation uptick, commodities usually perform well and tips usually beat nominal treasuries. At CLS, we have modestly increased our exposure to commodities and tips this year, though the increase hasn't been large. Our bias is to continue gradually adding to these positions. Okay, a higher stock market at this point in the year wasn't necessarily a surprise, unless one heard that bond yields had dramatically fallen, that inflation expectations were rising, and that small-cap stocks were significantly trailing the broader market. On the last point, a healthy stock market usually has small-cap stocks leading the way. Moving forward, our expectation is that the stock market could be choppy in the months ahead. The market often spins its wheels in the summertime, particularly before elections. Earnings growth may also slow in the quarters ahead, which puts another wind in the face of the stock market. As for CLS portfolios, we have toned down portfolio risk a notch, while still, of course, fulfilling our risk budget promises. We are also still emphasizing our high-quality theme, as higher quality securities should do better in a choppy market in addition to a slower growth environment. Lastly, we are also favoring larger companies over smaller companies, as we have for a few quarters now. So these are our three biggest surprises for us so far this year. As for that recent pop higher in the Russian stock market that Sierra mentioned earlier, that doesn't make the top three, especially after prices, valuations, and expectations had dropped so much for Russia prior to their lows earlier in the year. As investors, though, we shouldn't be surprised by anything. In the markets, anything can happen, and it usually does. And that's why we build balanced, diversified portfolios. They're humble. They acknowledge we don't exactly know what the future holds, except that long-term economic growth will remain positive and that the markets provide a way to participate in that growth. Thanks for watching. If you have any questions, please let us know. Stay balanced.
Thank you, Rusty. For our complete monthly market review, I invite you to download this month's PDF on clsinvest.com or subscribe to our podcast on iTunes. That concludes our update for the month of May 2014. We hope to see you back next Tuesday. Thank you very much for your time and trust in CLS Investments.